Contribution margin is a key concept when making decisions. It is the difference between revenues and variable costs. Managers use the contribution margin in 3 different ways. First, as an absolute amount of money. Second, as contribution margin per unit. Or third, as a percentage of revenues. Total contribution margin equals revenues minus variable costs. Or contribution margin per unit equals price per unit minus variable costs per unit. Or contribution margin ratio is equal to revenues minus variable costs divided by revenues, which is equal to the price per unit minus variable cost per unit divided by the price per unit. Different products have different contribution margins per unit. It is useful to know this information to assess how attractive each product is. The total contribution margin tells you what the company generates before having to pay for fixed costs. On a per-unit basis, it tells you how much money a company adds to its profits each time it sells a unit. This money is used first to pay fixed costs, and, once they are paid, it becomes profit. High contribution margin and low fixed costs are the dream of every business person because low fixed costs are paid quickly with little volume. But few companies enjoy such a situation. High contribution margin industries like utilities, airlines, hotels, and movie theaters tend to have high fixed costs, forcing them to search for high volume. Higher fixed costs are associated with riskier businesses' models because the fixed costs exist regardless of how much is sold. This is why the relationship between fixed and variable cost is an important variable called the operating leverage.